Pandemic, war, inflation. Our world is changing under our feet. Our Changing World podcast will keep you up to date on the changes affecting your business. We're talking with some of the sharpest minds out there so you can stay ahead of the curve. You will come away with practical strategies on how to adapt to our changing world. So today I'm excited to welcome James Davolos to Our Changing World. He is a portfolio manager at Horizon Kinetics, where he, since 2005, has co-managed the portfolio for the Inflation Beneficiaries ETF, which is INFL, as well as the Internet Fund and several other funds. So first of all, James, congrats on being selected as Best Stock Fund Manager by the Wall Street Journal for last year. Not only did Horizon Kinetics win Best Fund, you were also in second place and fourth place. So I'm really excited to be chatting with a top fund manager today.
Thanks so much for having me. I have to admit that it was a team effort, but They like me doing the media appearances.
That's awesome. So, part of the secret of your firm's success, I imagine, has something to do with your unique philosophy. So reading off your website here, Horizon Kinetics is a fundamental value, contrarian-oriented, fact-based investment advisor. So I thought that was pretty interesting, especially the contrarian piece. That's something we talk about a lot in the startup world. In order to make money, you have to bet against consensus and be right. So can you break down for us that philosophy and talk about how your firm goes about being contrarian and fact-based?
Sure. And I think that for those that aren't in the financial services industry, this might come as a bit of a surprise, but others that are a bit more cynical, maybe it won't be that surprising. But the orientation of the financial services industry is really aligned towards having very similar narratives. And a lot of that revolves around the two big profit centers. One is investment banking. The other is trading and lending. And all of that really benefits from everybody believing in certain narratives, growth, and honestly, everybody in the ecosystem benefits from rising prices, a lower cost of capital, seamlessly functioning markets, kind of like the go-go era leading up into last year. But, I think one of my favorite quotes is, you show me the incentives and I'll show you the outcome. Mm-hmm. And if everybody's incentivized to perpetuate these very rose-tinted views of the world and promote the largest, most lucrative companies because there's the most business to be won there, simply just by understanding that dynamic, we think that we can add a lot of value in our portfolios and to our shareholders. And so when the partners at my firm founded the firm in 1994, they started by looking at some of the biggest structural flaws or maybe tendencies within the industry that they felt like they could exploit. The number one was the time horizon, hence the name Horizon Kinetics, where everybody in this industry is paid off of December 31st calendar year. So it's a run for the roses to make sure that you get your returns in and get your P&L set by 12/31. But if we're investing for you to retire, that's a 30-year race, not a 1-year race. And so we thought that if we could simply extend that and then also just look at alternative data sources and challenge consensus narratives, that we could put out a really good investment product. And to the founders' credit, we've been going strong since 1994 and culminating in quite the year last year, as you mentioned.
Right. So this approach seems to be working well for you guys. Just to go a little bit deeper on that, I know I've heard you talk before about one of the elements is to go straight to the source documents. And another element is to bypass a lot of the, sell-side research or common sources of information out there so that you're not being biased in any way.
Exactly. And again, nothing against, there's brilliant individuals on the sell side and there's brilliant journalists, but go back to the incentive. The number one objective of a research analyst at a sell side bank is to get their clients or the bank's clients to transact. So that's why I think as of the December of last year, something like 94 or 92% of ratings on Wall Street were either buy or neutral. Mm-hmm. That's why sell ratings are so uncommon because A, you really want to promote people buying the stock? And you would say, well, don't you get paid if they sell the stock? The answer is yes. But if you put a sell rating on a company, chances are that company's management is not going to be all that inclined to do business with your bank in the future. Mm-hmm. As it relates to source documents, it comes back to a lot of the truth is in the interpretation. And so there's a lot of data which can be massaged. And I've looked at different data sets where, depending on the story that I want to paint, I could represent the data in diametrically opposing ways, one to show a very positive narrative, one to show a very negative narrative. And so it really behooves you to go directly to the data and the source, look at it yourself, and then draw your own conclusions, rather than relying on a third party, whether it's a journalist, a periodical, sell side, think tank, research outfit, what have you.
Yeah, I love that. And I think there's a lot of kind of universal takeaways there for anybody who's doing research or trying to think differently. So this approach is obviously working well for you guys, as we discussed your accomplishments and achievements earlier. So with this approach in mind, you have some interesting points of view about where we are in the market, including some cyclical changes that are underway. And there was a quote from last year in the Wall Street Journal that really got my attention, where you said, "We're transitioning from an era of abundance, of labor, raw materials, capital, to one of scarcity. Most wealth over recorded history has been stored in these assets, and we believe that the world will look back at this period as one where we realize their ongoing importance." So that quote really jumped out at me, and it was part of the reason why I reached out to you for today. So can you tell us a little bit more about this thesis, about the cyclical change that you're seeing and where we are today?
Absolutely. And just to start with the quote, it's the Western world in particular. So what I mean by that are the OECD developed market economies, mainly US, Canada, but also most of the European Union, UK. We've been enormous beneficiaries of globalization for the past 30 years. And in and of itself, globalization is inherently drives efficiency. So you get resources and labor from areas where they're scarce to where they're abundant. In this case, it happened to be very less developed economies and markets that had abundances of labor and materials. They were able to globalize and utilize a lot of that labor and materials, selling materials into the West, manufacturing, selling that into the West, and allowing the West to outsource a lot of their labor needs. That was wonderful for the emerging market economies because they experienced record GDP per capita growth. That's economic growth per person, which is really tantamount to growth in wealth per capita, so standard of living. The West benefited because we were able to extract a lot of profit margins and profitability for our corporations. Consumers enjoyed an abundance of products that are cheaper. So we kind of have this happy equilibrium where everybody's winning. The West is getting richer and fatter, pun intended, and the East is, coming off of a low base and doing just fine. The problem is that a lot of these variables are finite. There's only so much labor, demographic trends switch, and a lot of the raw materials, the highest quality and lowest extraction costs have been exploited. So now that these economies have risen to a relatively higher standard of living, they're competing with us for those resources, both labor and materials. Also at a time where post-pandemic, I think a lot of businesses and governments are rethinking. It's always been about efficiency for the better part of 30 years. And now I think the narrative is resilience. Mm-hmm. So you're seeing onshoring of supply chains and having excess inventory instead of just-in-time inventory and things like that. And so that's probably going to result in a world where, again, you have resilience over efficiency and more scarcity than abundance. That's probably, and there's a lot of other trends, but that's kind of it in a nutshell.
Yeah, so that definitely ties in with the theme of the podcast, which is our changing world. In other words, that the world we've gotten used to over the last 10 or even 30, 40 years is no longer the world that we're in. So it's just important to be mindful and aware of the changes that seem to be afoot. So one of the hot topics is whether this inflation is just transitory or things are sticking around. But based on this more structural approach that you've laid out, it does sound like we're in this for an extended period of time, not just a year or two, but that things are fundamentally changing. So do you have a view on how long this period you've described will be lasting?
I do. And I think that there's a big differentiation that needs to be made when people think about and look at inflation, because there are cyclical drivers of inflation that I think are going to moderate. Maybe they're going to moderate less than the consensus thinking is. But if you look at financial markets based on inflation expectations and Eurodollar futures and all of these other market metrics, everyone seems to be in consensus that we're going back to a pre-2020 world imminently and permanently. And maybe cyclical drivers will, but I think there's two really important things to consider. One is that prices are about 20% higher than they were in 2019. So to go back, you need massive deflation, not disinflation. So disinflation would be if we kind of stayed still. But you've already reset the bar 20% higher. And most people that I know, certainly hourly workers, are not nowhere near to earning 20% more income. And a lot of prices are up more than 20%. The other factor that's going to be really important is some of the cyclical inflation drivers are moderating as they should. So used cars, semiconductor chips, and capital goods. So washers and dryers and windows and piping. I mean, if you had to renovate or build or buy a house during the pandemic, you couldn't get that stuff. And auto manufacturing facilities were closed and you couldn't get microprocessors and semiconductors to put them in there. Anyway, all of those markets, there is a supply response. The supply response has happened and you're starting to see more balance. Those other factors I mentioned earlier about inventory levels and supply chains, and maybe that's going to keep prices a little bit higher for longer, but I don't think they're going to continue to really rise. The other side are what we call structural inflation drivers, where it's much more supply sensitive. So traditional energy sources, industrial metals, the agricultural complex, whether it's grains and seed oils or fertilizer, there's been a supply disruption in all of those markets for a variety of reasons. But at the end of the day, demand is going to be very resilient. You need to eat. You need to heat your home. You need to power your car. The industrial metals are going to be absolutely critical in the electrification trends that the whole world is pursuing. So there's two reasons why we think these are going to be very enduring and probably rise and contribute to higher for longer inflation. One is that all of the central bank policies today are oriented at reducing demand. So you hike interest rates, consumers can spend less, businesses can consume less, and ideally for them, inflation comes down because demand is neutralized. That only gets you so far with things like food and energy. The other variable is that probably for at least 10 years, arguably 15 to 20 years, there's been underinvestment in these markets. And you can go down a rabbit hole and say, oh, it's these ESG things, it's politicians that don't know what they're doing. But at the root of it, it's capitalism did its job. We oversupplied the world with raw materials from 2003 to 2007 when we had the emerging market growth miracle, the BRICS, Brazil, Russia, India, China. And everybody acted like that growth was going to last forever. It didn't, and we were oversupplied for decades. So capital goes to where it's treated well, and capital was not treated well in those markets, and so it fled. The problem is that now we're balanced again and capital is not going back into these markets. And for things like a copper mine, it takes 15 years to get it online. Obviously, agriculture takes a very long time. If you forego a planting season with fertilizer, that can have deleterious effects for many more growing seasons. So that's why we think that there's going to be higher structural inflation, and there's just not a lot we can do about it, especially when, to use a metaphor, we're putting a Band-Aid on a patient who needs surgery. Rising interest rates is the Band-Aid. Adding to supply is the surgery.
Yeah, so you did a great job of setting up where we are, some of these persistent issues that will be around for a long time. So based on that view, your firm has set up this ETF, Horizon Kinetics Inflation Beneficiaries, INFL. So you've invested based upon this point of view. And here in this fund, you've invested in some derivatives of natural resources that we touched on, as well as some other things. So could you kind of briefly walk us through what's in this ETF?
So the main premise is getting exposure to these hard asset variables that we think are going to do well in this new environment. And a hard asset is just what it sounds like. It's tangible, it's finite, it has fairly inelastic, meaning very resilient demand. But these tend to be bad investments. So whether you're buying barrels of oil or buying copper concentrate, you have to store it somewhere that costs money. And then if you invest in the companies that produce it, they're very risky. They use a lot of debt. They have bad returns. So our overlay is what we call capital light businesses. So think about all those variables and those drivers I spoke about, but then you overlay a business model that has high profit margins, the ability to scale. So you have higher profitability with more volume, and attractive valuations. So most people aren't really familiar that these businesses even exist, but there's a subset of precious metal, industrial metal, and energy, which are called royalties. Actually, royalties also exist in music and pharmaceuticals, where instead of developing the pharmaceutical or mining the copper or extracting the oil and gas, you have a financial interest. So a royalty on the revenue produced by those activities by somebody else.
Can you give us a concrete example of one of these royalty companies so we can see how it works in practice?
Sure. I think that the largest royalty company in the world today is a company called Franco-Nevada Corporation. And it's a Canadian precious metal-based royalty where most of it is gold, there's some silver, there's some platinum metals, there's also some energy and some other things. But in a really simplified example, there might be a large mine where there's a multinational mining company that's mining for copper, and gold is a byproduct in a lot of copper mining. So how do they finance that mine? One form is equity, so they sell an interest in their company. The other is debt. They borrow money to develop that mine. The third type of royalty is called royalty financing, where let's say, large mining company XYZ spends $1 billion to develop a mine in Chile. They use some debt to do it. They use some equity to do it. And those are effectively their constituents. But before anybody gets paid, the royalty is a revenue interest off the top. So let's say that mine does, again, use easy numbers, 100,000 ounces a year for 50 years. The royalty might give Franco-Nevada 5% of that production, which is usually settled in cash. So the price of gold times the amount of production, that goes right to the royalty company, such that their margin on that is effectively 97 to 99%. They're basically just cashing checks and auditing production. And then the entire employee and staff at Franco-Nevada, I think, is 44 people.
Wow.
So even their net margins on a full cycle adjusted basis can be as high as 70% after tax. So that shows you the beauty of the model, where someone else spends the money to develop it. The miner could be losing money hand over fist, but you're making 97% margins, just clipping your royalty off of the top of the pot.
So royalty business models sound like pretty much the dream. That sounds pretty good. And I've heard you refer to them as mailbox companies. Is that the term that you've used? Basically,
so, yeah. In West Texas, in all of Texas, where royalties are very prominent in energy, ranchers who own land that they lease out to oil and gas companies call it mailbox money, because they basically walk out of their house, open their mailbox once a month, and there's their royalty check, and that's what they had to do to earn it.
Mm-hmm. Yeah, it sounds like a pretty good business model to me. We hope you're enjoying this episode. To keep up to date on future episodes, please subscribe wherever you get your podcasts. And while you're there, leave a star rating and any suggestions you have for future topics. Now back to our show. In the interest of time, we will go and talk about the next topic, which is the tech world. So Here we've been talking about the world of hard assets, energy, minerals, all the things in the ETF. So now I'm curious how that is going to affect the world of tech. There's this term, the revenge of the old economy, that's been thrown out by Goldman Sachs. So we're talking about these old school physical hard assets. So what happens to the tech world, the things that were the superstars of the last cycle?
I think that there's still a lot of opportunity in tech and innovation and disruption and all these narratives, but business models matter. I think that's going to be the mantra where for a couple of years you could throw a dart at the NASDAQ or, any Silicon Valley startup, all these SPACs. And if you really looked at and they were just going up incessantly, but maybe they were growing revenue, maybe they weren't, but none of them were making any profits and none of them really had any visible path to making economic returns. So I think the two biggest trends that are going to affect tech and the broader market going forward, one is the scarcity of growth. So GDP growth is basically a function of labor supply growth or the labor force growth rate and productivity. A lot of reasons why labor force really can't grow that much. A lot of reasons why productivity is reaching some limits. So in a lower growth world with more costs, there's going to be less and harder to come by growth. So if you really do have an advantage business model that can grow and do it economically, you're going to be rewarded. If you can't and you're betting on, broader market-based growth, you're going to have a really tough time. The other one is profitability. So there's plenty of companies that were growing revenue at feverish clips, but none of that was converting into cash flow. There's a couple business models out there, many of which some of them are public, where I looked at the financials and I looked at the business and they were quite literally selling $1 for 50 cents. And so it's like, yeah, that's going to grow. But how do you convert that into being an economically viable business? And I think shareholders and capital markets are going to be a lot more discerning about which businesses can transition to profit mode, where everybody promises at the outset, I can be Jeff Bezos, where one day I can flick my profit switch. Well, the core Amazon business still barely makes money. It's their web services that makes money. So looking for analogs of companies that lost money forever and flicked a profit switch and were still able to grow are very few and far between. Netflix is a good example. Grow, lose money. All of a sudden, they are starting to make some money, but they're not growing the way that they once were. So again, that transition is going to be far more under a microscope. And I think that founders and innovators and entrepreneurs need to think about that day one instead of saying, let's get market share, let's get size, and then think about that transition.
Yeah, I think that's super important and will definitely impact the startup world. It's a bit of a mindset shift. So if we're talking about tech, we cannot skip over the topic of crypto. And I was actually surprised to see that on the one hand, you were talking about the return of hard assets, things you dig up out of the ground. On the other hand, your firm does have crypto holdings, or did as of the last time I checked on your website. So how do you kind of square those two things? On the one hand, hard assets, on the other hand, this digital asset?
Yeah, that's a great question. And you might be surprised to learn that we were the first firm to launch an internet fund in, I believe it was 1996. It was long before I joined in 2005. But the founders identify these big disruptive changes in the world. And, the internet is obviously on one side of the spectrum, and then a return to the old economy and hard assets is another. But I think that crypto has the potential to do some remarkable things in the world. And I talked about the lack of productivity growth. Could certain decentralized finance applications and blockchain applications help us getting some of that productivity that the world lacks? Maybe.
Yeah, let's hope so, because it sounds like there's not going to be a lot of growth in the future. So let's hope that Web3 is something that really drives it.
Yeah. I mean, again, there's other things that are exciting out there. But going back to kind of crypto, we really focus on cryptos that have finite supply. So it's hard to understand the economic or the business case for you to hold a token with infinite supply potential. But something like Bitcoin, where there's a finite supply that's that's set at a maximum by the algorithm and by the coding, that plus the functionality of what the blockchain that powers it can do, there's a lot of things that I think resemble hard assets, even though it's in the digital sphere. One more continuation on that theme is the concept of fiat currencies. So dollars, euros, yen, pounds. These are really figments of modern history, but every time we've debased a fiat currency throughout history, it's basically been the beginning of the end of that currency. And a great story that I love is the Roman denarius. So the denarius was their currency, and originally it was 100% bronze, which is a mixture of copper and tin. And obviously bronze is very valuable. But as the Roman Empire expanded and as they needed to hire more and more mercenaries for their military, they basically started adding more and more ores or unvaluable metals blending into the denarius, to the point where by the end of the reign of the denarius as a currency, I think it was 5 or 10% bronze, to the point where the end of it was actually when the mercenaries refused to accept the coins as payment anymore.
They literally debased their currency by blending in the crap metals along with the good stuff.
Yeah, and that's where the term debasement comes from. You're debasing the metal and debasing the anyway. There's parallels to that with what's going on with all of the major fiat currencies today. So the U.S. federal deficit is estimated to be at least $1 trillion a year for the next decade, approaching to and exceeding $2 trillion by 2032. And they expect us, the public, to fund every penny of that. So the Federal Reserve says we're no longer buying bonds, and in fact, we're selling them. So that leaves everyone else to buy these bonds, where we can't live within our means. We're increasing money supply. And so I think certainly the hegemon of the dollar will be questioned within our lifetimes. I don't know what could supplant it. And I do not think crypto will, but I do think that crypto is an outlet where people could say, hey, wait a second, I don't necessarily want to have yen or, dollars or euros or pounds. Let me find something that stores value, whether it's gold or royalties or agriculture or crypto. Buyer beware, obviously, that there's a lot more to the story than that, but that's why it kind of came into our lens, and we did a lot of work on it, and we have a wonderful team that can speak far more eloquently on it than I can.
Yeah, but it really all ties together, because we started by talking about inflation and, of course, crypto and the debasement of the U.S. currency. Kind of all comes full circle. So I'd like to wrap things up here and draw some kind of general lessons from what we talked about today for my audience, who is people who are tech execs, business operators, entrepreneurs. And there were 3 big things that I thought were themes that we talked about. So the first one is be contrarian. Don't just trust these sources that are readily available. Do your own homework. Go to the source docs. Go to the raw data, and do your own thinking. The second would be the economic cycle is changing. The things you've gotten used to over the last 10 years may not apply. So keep your eyes open and just be aware that things will be very different in terms of a scarcity of hard assets and scarcity of growth. And then finally, business model is so important. You talked about the royalty business model, which is super appealing. So any business person really should be thinking about margins and whether or not inflation will compress their margin. So those are my 3 big takeaways that I think anybody, whether you're an investor or a business person, could learn from today's conversation. James, any others that you would like to add?
No, I think, again, just to riff off one that I like that you brought up, which is that the past is not always analog for the future. And so many intelligent people take this false sense of security in having the large amounts of data and being able to analyze that data. But what if there were a lot of unrepeatable trends over the past 10, 20, 30 years that made that more of an anomaly than what the world normally functions like? So again, whether it's finance or tech or economics or health, everyone just uses trailing data to forecast the future. But really understand what led to that past and is that still valid going forward.
Yeah, I think that's a great way to tie up the conversation. So just to end on a more fun note, I know you're an avid reader. Are there any books that you can think of or articles or movies that really influenced your thinking?
Yeah, there's one that actually my boss, Peter Doyle, gave to me, which was called 0 to 1. And just, I'm sure all these entrepreneurs, and maybe it won't be all that inspiring, but just the concept of going from kind of nothing to something. That is such a bigger change going from 0 to 1 than going from, any other number to another. That's the biggest change and the biggest transformation. So I think that especially in kind of the world today, whether it's crypto or hard assets or innovation, that's kind of something that really resonated in my career. I also love biographies. Murray Stahl, our chairman, wrote a book actually called How They Did It. I don't think it's in print, but if you reach out to Horizon, we're pretty generous in sending them out. But he studied about 50 entrepreneurs, and most of them are rags to riches, and it's how they do it. And he goes through all of these people all over the world, Southeast Asia, Europe, US, South America, and analyzes how these people did it throughout history. And it's fascinating, just the ingenuity and work ethic and thoughtfulness of these types of entrepreneurs.
I will definitely reach out. I love biographies as well. And that is actually one of the ideas I have for another podcast, interviewing entrepreneurs. So I'm definitely going to reach out for that book. That sounds really great. So thank you so much, James. This was a really interesting conversation, and I really appreciate your time today. So just another fun topic. I hear you're getting into golf as well.
Slowly. I have 2 small children, so it's more of a pastime that I'm very bad at, but I still just love being out there.
Well, if you ever want to play with anyone who's definitely worse than you, I'm also starting to learn as well. So once the weather warms up in New York. But thank you again, James, for your time. I really enjoyed our conversation, and I know everybody else listening was going to enjoy it as well. Thank you again.